Hello everyone. In last FOMC meeting, Fed Chairman Jerome Powell announced cutting Fed fund rates by half a basis points to 4.75% to 5%. A lot of people in Wall Street were very surprised at this large magnitude of rate cuts, as a lot of people are expecting that Fed would cut interest rate by only 25 basis point instead of 50 basis points. But in last CME tracker, the expected probability rate is spiked up by 50 basis points in last 2 weeks. And that's mostly because I think the labor market was softening, and also the 10-year benchmark rates was dropping significantly in last couple of weeks, pretty good at this particular time. This is what he said during the meeting.
That inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections have...
Now, whenever Fed either rise interest rates or cuts interest rate, it impacts finance of common people. Whenever we have invested money, whether we are in stock market or bond markets or in commodities, or if we have credit cards or mortgages, car loans, or if you're investing money in a bank, say like, if I have savings account or money market accounts, or high yield savings account, all the rates are going to be impacted. So let's go one by one. So whenever the rate is coming down, the federal, it will immediately impact all your savings or money market rate accounts. Within a week or so, the rate is going to be reflect. If you are earning money, say for example, if you have invested money in your savings account and earning monthly interest rate, all the rates are going to be coming down, and that happens pretty quickly because Fed fund rates actually is the rate which Federal Reserve loans money to other banks. So if the banks are getting able to get cheaper money at a cheaper rate, so they're going to be basically like cutting the rates to the consumers as well. Now let's talk about mortgages. So the mortgage rates immediately doesn't impact on the Fed fund rates. Actually, I did make a video. If you look up how basically mortgage rates impact, mortgage rate mostly like is very sensitive to the 10-year treasury and the 10-year, but it doesn't impact immediately on the mortgage rates, although it is expected the mortgage rates are going to be coming down because the Fed is going to be on a easing cycle, meaning the Fed fund rates are going to be coming down over a period of time at the end of this year and the next year, perhaps in 2026 as well. So that's about mortgages. In terms of credit card rates, credit card rates are not going to be impacted very heavily. Say, for example, if you're like have a loan, credit card loan, say $10,000. The rates are very high. Credit card rates are usually 23, 24%. And if the Fed is cutting, 50 basis points, there's not going to be huge like amount of the interest rates from the credit card interest rates. So it might come down some amount, but in terms of your monthly payments, it's not going to be significantly different, although it's going to be helpful in getting your the monthly payments. It's not going to be making significant difference immediately. And let's talk about auto loans. On the auto loans, I think it's around 7% for new cars, 11% for the used vehicles. So whenever the Fed cuts rates, the interest rates, it does get impacted, but especially if you do not have good credit rating. If you have good credit rating, you are going to get good benefits whenever you buy a new car. But if your credit rating is not at a very high, good standing, cut rates is not going to go down towards the car loans that you are going to be paying. So it's a good idea to increase your credit rating whenever possible. So now let's talk about historically, like what would have happened after basically a rate cut is enacted. So Federal Reserve were increasing rates after the COVID. The interest rate, the Fed fund rate came to almost 0%. Since that time, the inflation picked up, and to bring inflation down, Federal Reserve raised interest rate 11 times, and it reached a level of almost it reached the level of 5.25 to 5% level Fed fund rates, and kept it high for significant amount of time. So with these high interest rates, and inflation started coming down, and inflation is, although the Fed has the target of 2%, inflation, they're not 2% there yet, but the labor market also is like softening. Whenever the labor market softens, oftentimes it doesn't bounce back immediately. So the Fed has to be careful that the economy doesn't go into a recession or like a significant slowdown. That is why they have been proactive this time to cut interest rate, because Fed also did wrong basically at one time, that they were not increasing interest rate, thinking it was a transitory inflation, and they were completely wrong. So this time around, I think that since the labor market numbers were not stellar, so they have been basically like proactive cutting interest rates. So in this particular remaining section, we're going to talk about what happens like since 1972, how the different asset classes they have behaved during his last many Fed rate cut cycle. There has been since 1989. In this video, I've been following up this information from pinpointmacro.com, where they have summarized the various projection, historical information regarding the Fed rate cut cycles. So in these last 7 cycles, they were showing how many times basically the rate cuts were performed during those like 1989 till now. So there were like there were number of cuts. There were 1, 2, 3, 4, 7 cuts during 1989. Now during that cycles, going back to time 1973, even before till 2019, they have stabilized in 3 months, 6 months, and 1 year what the US gross domestic product growth has been. So let's talk at they have best, worst, and mean. The mean is like in 3 months, GDP goes up by 0.6%. It goes up in 0.6% in 6 months as well. But in 1 year, the GDP goes up by 1.9%. So does the economy expands significantly after a Fed rate cuts. Unemployment. We're just going down like the mean numbers. After 1 year, the unemployment can go up as well to 1.1%. Personal consumption expenditure. This is the inflation. So inflation remains pretty steady. In 3 months, 0.2%. In 6 months, 0.3%. In 1 year, only 0.1% PCE growth. Housing price. I also made a video on mortgages and some information about U.S. housing, and this is very important. A lot of people, they are homeowners or planning to buy homes. So after Fed cut rates, the mean after 3 months, the house price performance, it goes up by 0.9%. After 6 months, 1.7%, and after a year, it goes to 3.5%. So house price could appreciate significantly after a Fed rate cut. Similarly, S&P 500, the market containing the blue chip 500 companies. After 1 year, the S&P 500 appreciation, the mean for last as many years, is around 4.9%. The market can expect to do well after a rate cuts. And the sectorially, if you want to see this heat map, you could see like in this green color, like in 12 months in the last column, it says the consumer non-cyclical, consumer cyclical, technology and healthcare companies tend to do well. The average mean number is like 4.5% from healthcare, 5.2%, 7%, all the way to 7.7% after the first rate cut in different sectorial alphas. 10-year treasury, if you're investing in a bond markets, after 1 year, mean like 10-year treasury could go down 0.1%. It can go down. Dollar index, it could go up 1.6% after 1 year. Commodity, gold has been on a tear this time, and historically in as many years, in 1973, gold price has appreciated on a mean 2.1% after Fed rate cuts 1 year. Oil has been down. I'm looking at the last row in the right last column, down 2.2%. Commodity prices is going down 0.4%. The VIX index, the volatility index, it does spike up after 1 year to very high 13.7%. So there could be a lot of volatility after the Fed cut rates. So this is basically like very important historical numbers. If you're if you're an investor, you could get some idea historically in different areas like whether bond market, stock market, housing, inflation, unemployment. These are the historical numbers, and this is what the Fed rate cuts basically the Fed fund rates are going to be trailing down. And the chairman also mentioned in his summary of economy projection, he did talk about the unemployment projections, Fed rates number projections, and a couple of other the projections as he has talked in his meeting. So hopefully you found this video interesting. If you liked it, please do subscribe it, or if you have any comments, I would appreciate. Happy investing, and speak to you again in the next video. Have a nice day.